Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul. And good morning to all of our viewers and our listeners out there. Welcome back again. It's Tuesday morning. I'm Barry Saywitz, president of the Saywitz Company, managing partner of Saywitz Properties, and we are talking real estate. We're back at it again. I'm excited about today's show only because we have no guest. And we did it on purpose, so nobody get panicked. I am, for those of you who are watching on the video, I am drinking double-fisted. I have coffee, and then I have coffee, just to make sure I'm awake.
That's right.
But today we decided we would do the show a little bit different, and we thought we'd do a third quarter / fourth quarter update, wrap-up, crystal ball kind of a show on the office and the leasing markets here in Southern California and Orange County in particular. And so we thought we'd have a little discussion, and Paul's going to act as my interviewer and griller and asker of questions, and I'm going to try and rattle off some fun facts. So,
we're going to pin you for some answers this time, too. Everybody's like, well, we'll see. It could be. It's wait and see.
You know, I would vote 50% on red and 50% on black.
Yeah.
Try and play it safe.
I think that's the way the market. So let's jump right into it here. We've talked a couple times over the last year about the coming change, the new reality that we're all waiting for. Office is going to pivot. Industrial is going to cool. Things are going to go back to some sort of normalcy. Are we there, or are we still waiting for that occurrence?
Yeah, I don't know what the new norm is, and by the time you get there, it changes, and then there's something else going on. Although I will tell you, you blink, and you're in the end of the third quarter, going into the fourth quarter of the year. I mean, I feel like we just did the sort of New Year show talking about what was going to happen for the year. And we were trying to prognosticate in terms of what the trends would be for the year. And here we are now looking back, and not much has changed. Little bits of changes in where we are in the cycle of the market. But the fact of the matter is, as we sit today, you have interest rates at a high in terms of recent years, with the exception of the run up in the 70s and the 80s, but
right.
People have to get used to 6 and 7% interest rates, and then we'll see if it ticks up a little bit more, or if it flattens, or if it pulls back a little. Everybody's got their own opinion on it, but you're not going to see 3 and 4% interest rates. So now the trick is, on the investment side and on from the banker's perspective, you have to start underwriting and penciling these properties based on a realistic cap rate and a realistic interest rate in today's market. And so buying a property at a 3.5 cap in Southern California and then going and getting 7% interest, in my book, just doesn't hunt. And unless you have someone who's buying it because of a fix-up or a tear-down or some sort of value add, really doesn't make any sense. And so the other disconnect that we've seen is you have sellers trying to hold on to yesterday's prices, and then you have the broker still trying to get the listing, so he tells them whatever he wants, and then you don't have a buyer that's willing to pay that, and so now you don't make any deals. So the transaction volume slows down, and then by the time you realize that you're not getting the action that you want, you have to pull back. Now, the reality of it is, you may have started at a price that was so ridiculous that even when you reduce it, it's still not a great number.
Yeah.
But I'll give you an example, which is that we have a client that has a building, and they were trying to sell it, and I'll just pick a number, and let's just call it $50 million. And then at $50 million, that was yesterday's number, and we told the client that, and they said, let's try it anyway. And then after we marketed it for several months, no one was offering that number. And then we didn't get any action, and then we finally convinced them to reduce the price, and then they reduced it to $45 million, and which was a huge reduction, but was still now getting into the realm of a realistic price. And then we started to get all kinds of action, but the offers we got were $35 and $40 million, because the buyers are now hitting below the belt going, hey, I'm looking for a deal.
And
So
we
now,
saw you drop it, so maybe you drop it some more.
right, and maybe you're desperate, or maybe it still doesn't pencil at 45 million, and so now you're trying to find somebody that'll get you to your number. And if it doesn't happen again, guess what you're doing? You're chasing the market down. And so, fortunately, we dropped the price and we got several offers, and so we have more activity because it's more realistically priced. But sellers don't really want to hear that, and the broker's hesitant to tell them that because they don't want to be the bearer of bad news. And so you have a disconnect. And so I guess, if we're talking, let's break it down in sectors.
Right.
Let's talk about the office market, and then we can kind of jump to
That's
the
the one I
industrial market.
don't understand yet. We kept waiting for one of two things to happen. Either COVID would clear for the most part, we'd get used to it, and everybody would come back, and they didn't. Or then we said, well, then that's the new normal, and we're going to have to deal with lower occupancy and maybe repurpose some of these buildings into apartments or other sorts of things. That happened in Laguna Niguel, down by Costco there. They tore down an office tower and built apartments out of it there.
Yeah, and so I don't think you're going to see widespread scenarios where you're starting to tear down office buildings. If you have
Or tear them apart and somehow...
yeah, I mean, in that case, you had an old antiquated product, and you had an opportunity to build a new product with a different use that would yield a much better result. But you're not going to start tearing down high rises in downtown Los Angeles and building either apartments or movie theaters or something else. And so, what you have happen.
So we're never going to implode them like we do Vegas casinos and just start over again.
I don't see that happening. Certainly not in the short term. The reality of it is, if I owned an office building, what I'd be doing is figuring out how I try and fill it, and then we do, and then that's what we're trying to do. So now the question is, what do you do? Because the rental market on the office side, I don't care where you are in Southern California, it's not as strong if you're the landlord than it was a year ago or 2 years ago,
Right.
or certainly pre-COVID. And so you had people bail out, you had people take less space, you had people retrade their space, you had companies go on out of business. I think the majority of that's over. What I do see happening now in terms of a trend is you have companies that have leases coming up, right? So
Right.
typical office lease is 3 or 5 or maybe 7 years. And so let's just say 5 years. And now if you rewind, 2020 was COVID, and then we are going into shortly 2024, which means
2024,
that
hard
almost,
to believe, right?
Right. So if I had a 5-year lease, or if anyone had a 5-year lease, it would, after 5 years, all of them would have expired. So by 2025, everyone who had a lease pre-COVID will have expired. What that means is, at the end of my lease, I have an opportunity to reevaluate my space, take less, different design, more relocate, or look for cheaper space if I'm looking to save money. And so now there's a bunch of movement in the market, and it's all, for the most part, in a downward trend. You don't have a lot of companies expanding, taking big chunks of space, so it's not absorbing the space in the market. On top of that, you have a bunch of smaller spaces that are now sitting empty, and so I need to refill them with other businesses, yet new businesses are not really coming about the way they were.
Right.
And new businesses that are starting up, a lot of them are just working out of their house as long as they possibly can. So you don't have the backfill like you might have had in other cycles of the market yet. It doesn't mean it's not going to happen, but at the moment it's not happening.
So is it just natural growth as new companies are born, as new people graduate from law school and want to open their own firm or whatever?
I think, or I think, look, you have a technology firm here in Southern California. There's a lot of growth in the technology industry, and so maybe they have people that they're just having intrinsic growth. But you don't have intrinsic growth and then have 3,000 square feet of office space with 15 employees, and then next time I go to rent space, maybe I rent 4,000 or 5,000 feet of office space that would accommodate 20 or 25 employees. That's not going to change the market and move the needle dramatically in a day or a week or a month, right? And so you don't have mortgage companies taking down 50 or 100,000 square feet. You don't have, like you had in the .com.bomb era, where you had companies just taking down space that they didn't even need yet, that they were going to fill with people that they were going to hire. And there are a few anomalies to that, but for the most part, everybody's pretty conscious about the space that they're taking and trying to make it efficient. And so what that does is it just softens the market. And so now you have lots of opportunities. We have a client, we're looking for space in the Irvine spectrum, and when we ran the search, they're looking for 5,000 square feet, which is a typical sort of average size of space. And there were 90 spaces in the geographical area we looked at, And then we chipped them down and eliminated the really junky buildings and the really very expensive buildings, and they didn't want to be in a high rise, and applied all of their filters, and we were still left with 35 buildings after chipping it all down. And then that's a lot of spaces. So if you're a landlord and you're one of 35, what are you doing that's going to make your space stand out from the other 34? Right? And that's either price or the location or a perfect fit. And
Or
so
free rent.
right. So now I've got to, and so you're back to this methodology with you, which is if you're a landlord and I got a guy looking at my space and he's looking at 2 or 3 others. If I don't make this deal, how much longer is it going to take until I get the next guy around? And so do I offer free rent? Do I offer concessions? Do I drop the rate? And the answer is I have to, because if I don't, I'm just going to lose the deal and the next guy might not be around for a while. And as much as I don't like it, that might just be a factor of how I get my building filled, and something's better than nothing. And if it's a good tenant and they're ready to move quickly, that's a benefit to the landlord.
So let me ask you that, follow up on that question here, that statement. Something is better than nothing. I remember vividly the 90s, and when we had the first big, I don't know, it was like stay alive till 95.
Right. Well, so I did someone else's podcast last week, and they asked me. They said it's stay alive till 2025. I said, well, you're just borrowing a term from the 90s. Yeah. It's not stay alive till 2025, and that's what I told them. I think people will stay alive. I don't think you're going to start seeing people go under, but you have to, try and make some deals where you can. And it's not a bloodbath, but you have to be smart about what it is that you're doing. So on the landlord side, right, you need to try and either keep your building filled or fill it as best you can and get creative in terms of making deals. You can't start gutting the space and spending an arm and a leg. If that's the case, you might as well just let it sit for another year and try and find somebody that needs the space in a closer fit than what you have. If you're a tenant and your lease is coming up, or you're out in the market looking for space, now is an opportune time for you to take advantage of the softness and the dip in the market. So we talk to companies all the time, and then they say, well, I don't want to sign a long-term lease because I don't know where my business is going. I don't know where the economy is going. And then I say, well, look, it's a catch-22. You have to balance the real estate need against your business plan. Your business should drive the real estate, not vice versa.
Right.
However, you will kick yourself if you sign a 3-year lease, and then because you couldn't see into the future with your own business. And then in 3 years, if the market's stronger, you go back to renew your lease or look for space, then you're just going to pay more.
Right.
And then maybe then your business is clear. So you sign a 5 or a 7-year lease, and now you've locked in at a much higher rate, and you've just cost yourself a bunch of money versus your competitor or someone else who says, look, I'm going to take advantage of this. I'm going to sign a longer term lease and just lock it in. I don't have to worry about it. I mean, not much different than, refinancing your house when the rates were low. Those people who did 30-year mortgages at 2 and 3%, they're done. They're set, right? So, you unfortunately, you can't sign an office lease forever. So it's going to come up again. You have to try and just take advantage of the market and balance your long-term needs, your space needs, and where your business is headed against what you're doing today. But I tell people, look, sign as long a term a lease as you feel comfortable with, regardless of what the space is, and don't try and guess the market. But you have an opportunity to take advantage of it, you should.
But you got to guess your business, and that's what people are hedging on. I'm not sure if they're coming back. I'm not sure if I'm going to grow. I'm not sure if I'm going to stay and go somewhere else here. So they're not sure what to do. They're signing, I would think, shorter term leases these days.
It really just depends. I mean, I think it depends on your industry, and it depends on if you can figure your business out. If you can't figure your business out, you do a shorter term lease. If you're the landlord, you don't really have a choice, and you just do it. And then, but you're not going to spend a bunch of money to do a short-term lease. You just say, okay, I'm not going to spend any money.
Right.
You can do a short-term lease. I'll give you the flexibility of that. Give me my rent, and then I guess we'll just kick the can and we'll both talk another day.
So my question, I'm going to push you one more time on that 90s analogy. One of the things that shocked me in the 90s is, and I'll talk about retail space, because in those days I owned a couple of bars, so we were looking for third or fourth locations. And we'd see these empty shopping centers, lots of them. And we'd say, oh, good, they're going to cut the rent way down. And they
didn't, no. And I don't think you're going to, I mean, you've seen the cut in the office rates already. And again, I'll just go back to this analogy of this client we're looking at in the Irvine Spectrum. You have buildings that we're renting for $325 a square foot, $350 a square foot, and for those outside of Southern California, that's on a monthly basis.
Right.
So, $36 to $40 a foot annually. And today, when you sit down and talk to them and go, look, I like your space, but I have 3 others that I like as well, where are you going to be at the end of the day? That doesn't mean everybody just drops their pants and says whatever it takes, but 1 or 2 of them probably will, and then you wind up having a rate in the 250 or 260 range, and so now you've gotten a 20% reduction in the rate, and that's significant. But you're not going to see rates go to $1.50, partly because the landlord can't really afford to do that, and then secondly, you have a dilemma, which is if you're in a multi-tenant building and you have a bunch of tenants, and you start renting space at 50 cents on the dollar, then it's going to come back to haunt you with all of the rest of the tenants.
Everybody else wants it.
Right. And
So
you
the
can't
other
do
thing
that.
I heard in the 90s that I didn't understand then, maybe it's still true, is a lot of these people finance these buildings based on some sort of pro forma, some sort of projection of what the rents are going to be. Based on that, the bank lent the money.
Right.
Now, if you go back and you start admitting to the bank, that pro forma is not work anymore. I'm only going to get half of that. Doesn't the bank threaten then to call in this loan then isn't secure, I'm going to call it in? And
Yeah, so we haven't seen that yet, but the what is the next step? What's going to trigger what happens next in the market, especially on
Right.
the office side, is 2 things, I think.
that's what we're looking for. All right.
Number one, and again, I'm no prognosticator, but this is what I think, right? So number one is the typical length of a lease of a tenant is 5 years.
Right.
So over the course of 5 years, every single lease will come up for the
Right.
most part. And if you did a 3-year lease, it would come up maybe close to twice. So if you rewind to the pre-COVID days of 2020, and then you fast forward to we're going to be in 2024 before you know it, almost every lease out there is expiring. So when
Right.
the lease expires, it gives the tenant an opportunity to rethink their space and look at different options, or give back some space, or remodel the space, or do something. And so over that course of time, everybody's lease comes up, in which case yesterday's number, if it's still not around, is gone.
Right.
So as a landlord, if you were getting this $350 a foot in your building and all the leases expire over a period of 3 or 4 years, you might be at, and the rates don't change, and you're now at $250. Guess what? All your rents are down. Now the value of your building is less and your cash flow is cut. So now it's back to the lending side of things, which is if I leveraged the building
Right.
and I did it based on that 350 number and I cannot get it and it's not available in the near future, and the lender knows it and I know it. Now, when the loan comes up for renewal, lender says either I'm not going to loan you as much money, or the building doesn't really pencil, or it's not worth what it once was. And so now that affects what the landlord's doing.
And
Now,
how
if you,
often does that renewal take place?
well, so a typical commercial loan on a commercial building would typically have like a 5-year fixed loan. So that means in 5 years, whenever you got it, that loan is going to come due. Now, it doesn't mean the loan's coming due. What it means is the interest rate may reset. So now it doesn't mean the lender says, hey, forget it, I want my money, our business is done here. What it does mean is if I had a rate at 3 or 4%, and all of a sudden it goes to 6 or 7%, I now have what I'm going to call a double kick in the knees, which is my rent's dropped, my interest rate goes up, my cash flow basically just shrinks twice, or twice as fast, or twice as much.
Right.
And then what happens is when I go to sell the building, it's not worth what it once was. And then also if I have to go get a new loan on the building, when the loan comes due, now I'm pinched in terms
That's a
of the dollars.
quadruple kick.
Yeah, so look, I had that happen to us in a number of instances with several lenders in the Great Recession in 2007, 2008, 2009, where rents went down by 40% and property values went down significantly, and then interest rates went up. And then if you had an interest-only loan and it converted to fully amortizing, there's your quadruple kick in the knees, right? And so you got it from all sides. And there's no question that lenders are taking a much tighter approach towards lending. And they're lending based on today's interest rates with today's cap rates, not yesterday's dollar.
So it sounds like there's a 5 year, you keep saying 5 years, 5 years. And if we assume that the baseline was 2020 when COVID first kicked in and we started to see sudden shifts in these markets here like office, we're looking at maybe this coming year so much, but a year
Well, that's
from now.
right. That's how you get to 2025, right? That's your 5 years. Plus, they figure the fallout of all the COVID stuff, and especially on the office. I mean, I think really on the office side, anybody who's working from home is going to continue to work from home. Any business owner who says, I want my employees back at work, they've already put their foot down and said, look, you're coming back, or you're doing hybrid, whatever it is, it is. And so now you have to look forward and say, okay, this might be the new norm where we have a hybrid scenario and I don't need as much space, but you're going to need some amount of space, and then we have to figure that out. But the other thing that we don't know is what's the next industry that may look to take down space. And so is that the tech industry? Is that healthcare? In the .com, you had all these software companies. In the run-up of the real estate market, you had all these mortgage companies. So there's going to be another industry. We just haven't seen it yet, and we don't know what it is.
Is defense coming back here in Orange County specifically? We've seen a return of Anduril, and they took over the old LA Times printing press, which was a big space, and they've quietly expanded and done some other things, and they're acquiring other companies because they really think Orange County is going to become a defense contractor again.
Yeah, I mean, look, I think that there's plenty of defense companies, and there's lots of aerospace companies and suppliers and manufacturers that are still here in Southern California. Those who couldn't afford it, they left or got bought. But that's one industry, and that industry is not going to drive the whole economy, right? You look in Los Angeles, especially, you had the entertainment industry where they were taking over industrial buildings, turning them into office space, turning them into studio sets, and then now what happens? You have a strike. Yeah. So everybody's on vacation, or got a picket sign, one of the two, or both. And so now that market's flattened, and
the cable wars have seen some attrition and cutbacks and other things. So that this endless growth, where there were 50 new channels and they all needed content, which meant more studios, more sound stages, more everything. I don't know if that's sustainable.
And then look, you switch gears and you look at the industrial market, and so you had all of these 3PL logistics companies that were taking big chunks of space, and then we're basically subleasing them out to their clients and handling their logistics for them. They didn't care what the rates were because they were passing the costs along to their own tenants or their own clients. And the client, I don't want to say they didn't care what the rate was, but it was still cheaper than them doing it themselves. So that drove the market up pre-COVID, and then you don't see as much of that anymore. And then you had Amazon taking all the space, and now they're not taking space anymore. So things shift. And then now if you look at the industrial markets, I mean, if we were to rewind a year ago, I'd tell you it's as tight as a drum. Vacancy's 1%. Every deal that's out there is more expensive than the last one. Every landlord is licking their chops, and every space that came on the market had 4, 5, 10 people looking at it.
Right.
That's not the case today. Now, I don't want to say the industrial market's soft by any means, because it's not. But at the same time, the vacancy is still very low, but there's more opportunities in the market than there were before. Things do not get leased in a day. There are not 10 people clamoring over the same space. And depending upon what it is, I mean, you don't have new buildings getting pre-leased 12 months before they're done.
Right.
You don't have space getting rented out from under people at 2 or 3 times what they were paying. I mean, there's still no question. We have clients we talk to all the time. You're paying yesterday's rent, and today's rent is 2.5 times what you're paying. And
which is like here in Southern California, $2.50 to maybe $3 or something if you factor in triple nets and everything else you were saying. And that used to be, and still is, AAA, Class A, whatever you want to call it, top-notch office.
Right. So look, we owned an industrial building in Compton, in Los Angeles, which wasn't the greatest part of town, and it wasn't the greatest building, but it was a good building. And I had it rented for $1 a square foot, and that was about the highest rent in the market. Now, I know when the market was in the toilet in the recession, space was renting in Compton for 40 or 50 cents a foot.
Wow.
And so today, if you go to rent that building, it's probably $1.50 a square foot, and so it's 50% more. I sold that building at the time for the highest price per square foot for an industrial building in Compton that I could ever find, and that was about $160 a foot. And it wasn't that long ago, maybe 5 years ago. And then today, that same building's probably worth $300 a foot. So, and then you say, why?
I'm sorry to laugh, but I mean, who would have thought that?
Well, yeah, I mean, it's a shoulda, woulda, all of those kinds of things. But the issue is, if you need 50,000 square feet and you need to be in Compton or any of the surrounding cities, you only have a handful of options that are out there. The other downside of it is you have some antiquated buildings that just aren't very functional, and so will those sit or will those not command as high a rent as a new building or a more functional building? The answer is yes.
Will cities ever start rolling up little properties into bigger properties? Or will they, you got all these lots of little parcels in places like Santa Ana or Westminster, whatever, that historically been small buildings. Will they start aggregating these into bigger properties and trying to go after bigger tenants here?
I don't think you're going to see the city do that. I think you'll see the free market potentially do that, where you have certain instances where you've knocked down buildings, either smaller buildings to build one larger one, or you've knocked down older antiquated office buildings that just aren't going to rent so quickly. And then those are getting turned into either apartments or industrial because they're a better, highest and best use in today's environment. But the issue is, if you start looking at the industrial market and you start, again, trying to prognosticate or crystal ball it and looking forward, what happens? And that's the same with the landlord and tenant. We talk to clients of ours that are tenants, and they say, well, isn't the market getting it softer? Shouldn't I do a short-term lease and then I can come back and get another bite in the apple in 3 years? And then I say, sure, but here's the thing. People said that 3 years ago. It's got to flatten. It's got to flatten. And then if you did a 3-year lease 3 years ago, you might be paying 30, 40, 50% more today. You shot yourself in the foot.
Well, that's the takeaway from this whole discussion. I keep hearing it's gotta. Interest rates gotta come down. People have gotta come back to work. Things have gotta do this. And I don't see any of those gottas.
No, and I think part of that is back to, you look at the overall economy, right? You have the stock market's up, it's down, it's back, it's forth. I mean, it can't get really, some sustained traction.
Right.
And then you have economic policies set by Washington or by Sacramento that are not driving and fueling business growth. And so you have certain industries and certain segments that are doing well. I mean, Apple, with the new iPhone, their stock will do well and they'll get a shot in the arm. Tesla took it in the shorts for a little while and then now it's popped back up. Those are anomalies. Those don't dictate the entire economy. You start looking at the entire economy, you have to talk to small business owners. And you have to see what they're saying, and you have to see if they're hiring people.
Right.
And people are skittish.
So only thing we've got to do is keep coming back to this show to stay, keep our finger on the pulse, stay current.
I guess. I mean, we can do it again in 6 months or 9 months, and then we'll see.
And
what
I wonder
goes.
if it'd be any different, if you'll still be saying,
And what's interesting is, we're 2 years into doing this show, and when we started it, there wasn't one guest who had anything bad to say about the real estate markets. Everything was up and up and up, and it's going to continue to go up. And then a year ago, it was, oh my gosh, it's changing, and it's definitely slowed down. And then here you are a year later, and you're in this, what I'm going to just call a state of flux, right? We're trying to figure out where to go.
And everybody, again, keeps saying the word gotta. It's got to come back to where it was. Interest rates have got to come down. When they do, we'll be ready. People have got to come back to work eventually.
I mean, look, I'm not getting any younger. I mean, I don't know when gotta is, and I don't know when it is, right? That's the crystal ball. At the same time, people have decisions that they have to make in today's world. If you're a landlord, you got to fill your building. If you're a tenant and your lease is up, you can't strike it out. There's an event, right? And so I have to try and capitalize on the event. And so what we tell people on the brokerage side is you have to start early. You have to go out and get educated on what your options are, whatever that might be, and then you have to try and create as much leverage as you can in the situation that you're at, and instead of just trying to kick the can and buy yourself some time.
Got to come back and hear more. And if they need help, if they got to get help, where do they go get help with this?
Yeah, well, look, I'll give a plug for the company, but you go to Saywitz.com and then you call and ask for help, and we'll help you. But again, no different than hiring an attorney to go to court, no different than hiring an accountant to do your taxes. You need professional real estate help, whoever that is. If you're a business owner, go get help. Just because you can go on Zillow or Craigslist or LoopNet and find out information and see properties that are available, that does not make you an expert in the real estate market. So please don't be short-sighted. It doesn't cost you anything out of pocket at the end of the day to get professional help on the real estate side. I don't care whether that's on the residential or the commercial side. Find somebody who can help you and add some value.
There you go. That's what we got to do. All right.
And I'll tell you what people got to do is they got to tune in next week. We'll see what happens.
I think that's it. That's the only thing I can know for sure. We got to keep listening. All right. Thanks for joining us here on another continuing, confusing, cloudy look into the crystal ball here.
Yeah, I'm Barry Saywitz. We'll see you next time.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.